In this video, we're going to take some. In this video, we're going to review some long-term managerial decision making, but this time, In this video, we're once again going to look at long-term managerial decision making, but this time, instead of having regular cash inflows where we get the same amount of money each year over the project's life, we're going to have irregular cash inflows, which means the amount of money we get each year is going to vary. We have valve manufacturing, and they again have two mutually exclusive options related to their manufacturing equipment. Plan A is to refurbish and upgrade the existing equipment they have, and Plan B is to purchase new equipment. Plan A requires an initial investment of $2 million. Plan B requires an initial investment of $3 million. Both plans have a residual value of 0, so this equipment, no matter if we refurbish what we have or buy new equipment, is going to be useless to us at the end of the plan's life. And we have the irregular cash inflows for each plan listed in the chart on the side. Plan A in year 1 is going to bring in inflows of $660,000, decreasing down to $520,000 in year 2, down to $420,000 in year 3, down to $320,000 in year 4, and then at $220,000 for the rest of Plan A's 8-year life. Plan B has a 10-year life, and as you can see in the table, the cash inflows are going to reduce each year until they become consistent at $220,000 in years 5 through 10 of Plan B's life. In total, Plan A is going to bring in $2.8 million in cash inflows, and Plan B is going to bring in $4.5 million. Let's first determine our payback, but now we have irregular cash inflows. We're going to start with Plan A. So for Plan A, what we need to do is figure out, after each inflow comes in, how much total inflow have we accumulated. So let's start in year 2. In year 2, we would have had the $660,000 inflow from year 1, plus the $520,000 inflow from year 2, bringing our total accumulated inflows up to $1,180,000. In year 3, we would have had another inflow of $420,000, bringing our accumulated inflows up to a total of $1.6 million. And in year 4, our table tells us that expected cash inflows are $320,000, which would increase our accumulated inflows to $1,920,000. And then we're going to have a series of 4 consecutive years of $220,000 in inflows, bringing our accumulated inflows up to $2.8 million. So now we need to figure out what is the payback period. And to do so, you need to find the point where you recover your initial investment from your accumulated inflows. What I advise you to do is go through your accumulated inflows and find the number that is as close to your initial investment as possible without going over. So at the end of year 4, we're going to have accumulated inflows of $1,920,000, which is pretty close to our $2 million investment. So it's going to take us 4 years and a little bit more to get paid back on our initial investment. Well, how much more? We can find that by taking the additional cash flows that we need and dividing it by the cash flows of the year in which we're going to recover. We know at the end of year 4 we're going to be close, but we're not going to be all the way there. So we're going to need some of that cash inflow from year 5. How much are we going to need? Enough to get from the $1,920,000 of accumulated inflows we'd have at the end of year 4 up to recover our $2 million initial investment for Plan A, which is $80,000. We need $80,000 in additional inflows from year 5. Well, year 5's annual inflows are $220,000, which means to get that $80,000, 0.3636 of a year is going to pass. Well, if we add that to the 4 years that we've already accounted for, our payback period for Plan A with these irregular cash inflows is going to be 4.36 years if you round to the nearest hundredth. Let's do the same thing for Plan B. In Plan B, we'll go through, we'll add up all of our annual inflows to find our accumulated inflows at the end of each year. And we should go and we should check how close we are, or we should go back and we should check what is the year that has the closest accumulated inflows to our initial investment. Well, that's going to be year 3, $2,860,000, which means we're going to need some inflows from year 4. How much are we going to need? Enough to get from that $2,860,000 in accumulated inflows we have at the end of year 3 up to our initial investment of $3 million. So $3 million minus $2,860,000 means we're going to need $140,000 in cash inflows from year 4. Well, if we take that $140,000 and divide it by year 4's inflows of $320,000, it's going to tell us what part of the year is going to have to pass for us to get enough money to get paid back our $3 million in total, and it comes out to be 0.4375. So if we round off to the nearest hundredth, Plan B has a payback of 3.44 years. So if we take on Plan B, which in this case is to buy new equipment, we get paid back pretty much a year faster than we would on Plan A if we refurbished our equipment. So Plan B in the case of payback here is more desirable. To determine your ARR with regular, irregular cash inflows, you're going to take the same steps that you had when you had regular cash inflows. First, you need to find your average annual operating income. So to do so, you take your cash inflows less your initial investment, gives you your total operating income over the life of the asset. And if we divide it by the number of years that it's expected to provide us cash inflows, for Plan A was 8, we're going to get our average annual operating income. Notice we have no depreciation to worry about here because both plans have a residual value of 0. So our average annual operating income that we're going to have for Plan A is $100,000, and for Plan B it's $150,000. Let's divide that by our average investment. Again, take your average investment, you take what the value, how much you have in it on the first day and how much it's worth on the last day. First day is going to be your initial investment into it. So Plan A has a cost of $2 million, Plan B has a cost of $3 million. Neither of them have a residual value, so both will be worth 0 at the end of the life of this investment, of undertaking this plan, which means to find the average of those two numbers, we just divide by 2. It'll be $1 million for your average investment in Plan A and $1.5 million for your average investment in Plan B, which means the accounting rate of return on both plans is actually 10%. So accounting rate of return being equal doesn't really help us here. Both plans are equally attractive. Let's determine our net present value with irregular cash inflows. And for this, we can't use the present value of an annuity table, because an annuity, by definition, means that each period has to be the same exact amount of money. For something to be an annuity, you would have to get, say, $1 million a year for the next 10 years. That's an annuity. Because our cash flows are irregular, we can't use the present value of an annuity table, which means we're going to have to go through and we're going to have to take the inflow from each period and multiply it by the respective present value of one factor for the amount of years it is in the future. So let's start with Plan A here. Plan A has a cash inflow of $660,000 during year 1. We need to multiply this by the proper present value factor. And to find that, you need the intersection of how many years in the future it is until you get this cash inflow and what your required rate of return is on all of your investments. In this case, this is our first year, so we're going to use n equals 1 or periods equal 1. We're going to go across that row until we find the number that intersects with our required rate of return, which is 14%, and that is going to be, according to this whole column here, 0.877. So if we multiply our net cash inflow by that factor, we get a present value of $578,820. On to year 2, when we're going to have a cash inflow of $520,000. Well, if we go down to our periods equal 2 row now and go across until we hit the number that intersects with our required rate of return of 14%, that's going to be 0.769. So if we multiply that by our net cash inflow, it's going to give it a present value of $399,880. We're going to repeat this process all the way down the line. We're going to take the respective cash inflow for the year. In year 3, it's $420,000, and multiply it by the factor that comes up at the intersection of the number of years in the future you have to wait to get it and your required rate of return. It's going to be 0.675 here for the present value factor of our third inflow, reducing its present value to $283,500. And from here, we're just going to rinse and repeat till we fill in the entire table, taking each year's cash inflow and multiplying it by that year's present value factor. We don't have to worry about a residual at the end of this because there was no residual value to take into consideration, so we can just multiply each year's net cash inflow by that respective present value factor, which is once again the intersection of the number of years in the future until you get that cash inflow and your required rate of return. In total, the present value of cash inflows for Plan A is going to be $1,831,360. So, if that is our present value of inflows, we subtract from it our initial investment, we get the net present value of Plan A. And as we can see here, the initial investment of $2 million is greater than our present value of cash inflows, which means we would lose $168,640 undertaking Plan A, which is to remodel and refurbish our existing equipment. We would lose out money on this if we take into consideration the time value of money, which means this is a no-go. Plan A is no good. We're going to throw it out right now. We're not refurbishing this equipment because it has a negative net present value. For Plan B, you would do the same exact thing. You would go through and you would take each year's respective cash inflow, multiply it by the present value factor that is at the intersection of your number of periods and your required rate of return of 14%. And then when you get done, you would add all those up to find the total present value of the entirety of your cash inflows. So for Plan B, using the same steps we just used for Plan A, you find out that the present value of all of your inflows is $3,063,540. The initial investment that we had in Plan B was $3 million, which means that the net present value of Plan B is $63,540. It's not good, but it is positive. And the rule of thumb is if you have a positive net present value, then you should undertake the project. We had two options. We had Plan A and Plan B. Plan A had a negative net present value. It's no good. We don't want Plan A. Plan B, it's not a big number, but it is still positive. So we'd still make money by buying this new equipment, more so than we would just not undertaking any project at all. So we should go through and execute Plan B. If we had more options, we would go through and we would search and we would find the one that has the highest net present value, and that is the option that we would choose. But we only have two here. Plan B is better than Plan A.